Okay, so we're going to continue building this chart using our amortization table. So for our year 4, we're going to copy interest. Year 4 would be 48. Oops, I think we're doing already payment. And then for year 5 would be equal to year 60. Now, I mean 160. Now for our balance, what we're gonna do is, for our balance in the first year, we will have our loan amount minus what we have paid in principal. For year 2, we will have the remaining from year 1 minus what we paid in year 2. For year 3, from year 2 minus what we paid in year 3. From year 4, we will have what's remaining from year 3 minus what we paid in year 4, and for year 5 equals remaining from year 4 minus year 5. And to finalize this chart, we have changed the sign of the interest by adding a negative sign in front of the after the equal, so that will make our calculations much easier afterwards. Okay, so our next chart will be property data. Same thing, we will have 5 years starting on 0, 1, 2, 3, 4, and 5. And the information that we're going to need is property value and rents. So for property value, we'll have at year 0, our property value is equal to the purchase price. And then for year number 1, the end of year number 1, we will have that it equals to the initial property value times 1 plus the property growth rate, which is 3%. And that's what we're going to do for all the years. So for year 2, we'll have year 1 times 1 plus property growth rate, which is 3%. Don't forget to put your parentheses. So for year 3 times 1 plus the growth rate, and so on for year 4 and year 5. Now for rent, we're going to do exactly the same, but we're going to start at the end of year 1 because we didn't have rent at the end of year 0. So for year 1, we will have that rent equals the 19,200, and then we're going to keep going with equals 1 times 1 plus, and then the rent growth, which is also 3%. So let's keep doing this until we're done with our chart. Okay, we're done calculating our property data. So if we want, we can just format these and make it look pretty by making it numbers and maybe less decimal places, but that's optional. Just the formatting thing. Now we're going to calculate our before tax cash flow for the owner. For before tax cash flow, we're also gonna do year and then 1, 2, 3, 4, and 5 to change, for example, the formatting of these cells of the borders. So we can just go there and do all borders, so now it looks just like the ones up in the upper side. Now we're gonna need property taxes. We're also gonna need insurance, maintenance, principal and interest, and finally cash outflows before taxes. For our year 1, we're gonna have that property taxes equal the property tax percentage times the purchase price. Purchase price right there. Now, for year 2, we will have that it is equal to what we had in year 1 times the property tax, which we are about to just lock so we can drag it down for all the numbers. So for example, in 5, we're going to verify that we have used the property value at year 4 multiplied by the property tax rate. Now for insurance was originally $1,000, and now for year 2 we're gonna do the original times 1 plus the expense growth, which in this case is 2%. Yes, and we're gonna keep going like that. Expense growth 3%. Now the maintenance is also an expense, so we're gonna do what we just did with insurance, considering the expense growth. In this area, the property taxes, the insurance, the maintenance, and principal interest is what we pay, and finally the cash outflows before taxes will come out of our pocket. So now for maintenance, initial will be 2,500. We'll keep doing what we just did now. Expense growth 3%. Don't forget to close your parentheses, or else you're gonna get a note saying that you didn't close your parentheses. So okay, now for principal and interest, which pretty much is very interesting because principal plus interest will give us the payment that we will make every single year. So equal, just for fun, we'll do principal interest plus principal, which equals our payment right here. So we're just going to drag that down, and we'll have exactly the same amount in every single line. Now for cash outflows before taxes, which is the payment that we will have to make, it's equal to property taxes plus insurance plus maintenance plus the actual payment that we'll do every year. That is equal to 21,383 with 72 cents. We'll just drag that down. Now we're going to go ahead and do a next chart that we will call the tax deductions from owning. For tax deductions, we will need 4 things: property taxes and interest, which will be our savings, total tax deductions, and finally, tax savings. Okay, we already calculated property taxes, so we're just going to equal those here, drag it down, make it really simple. For interest, we have also calculated that already. It is up here when we used our amortization table. We can also drag it down, have it ready. Now, for total tax deductions, we will just add up these two numbers, drag that formula down. And finally, for tax savings equal total tax deduction times the marginal tax rate. So we're going to do equal total tax deductions times marginal tax rate. We're going to log that one, and then we're going to drag these down. And those are our total savings every year for owning this property.